Hey guys, welcome back to Alpha Investor. Today we're going to start a new course series known as the Alpha Learn. Alright, so in today's session, we're going to share with you guys how to actually value stocks in the fastest possible way. Right, it can be as fast as just 1 second. Okay, it's just 1 second for all you need to know on how to value stocks. Right, but before we go on to that 1 second that cheat code in 1 second, right? I'm going to share with you guys more in specific what is this way to value stocks and why are people valuing stocks this way. All right, this is especially if you're a new investor and you're actually looking to learn more about investing in the stock market. This can be applied across every single market: Singapore Stock Exchange, Hong Kong Stock Exchange, Nasdaq, London, Australia, Thailand, so on and so forth. You can learn it like all it just takes is just 1 second, and it's really easy. All right, so before I share with you guys, first and foremost, I'd like you guys to scan this QR code over here, where I'm going to be sharing with you guys more of all this material, all the free analysis and materials in upcoming future. So do remember to scan this code, hit the pause button right now, scan this QR code, and you actually receive all of these things for free. There's zero money that is involved, right? 100% free of charge. Okay, so do remember to hit the subscribe, hit the scan me button, hit the pause button to scan the QR code. Okay, now today's sharing session, we're going to share with you guys more on this thing called the price to earnings ratio, the PE ratio. Right, if you guys have actually been through some stock courses, stock educational courses, they always emphasize on this thing called price to earnings ratio, but I'm sure that some of them may not explain it very well, so I'm here to actually re-emphasize on it again. So the purpose of price to earnings ratio is to compare the ratio between the stock price and the stock's earnings. Okay, now this is how the formula looks like. Price over the earnings per share. All right, so everything go by the per share because the share price is only for one share, right? So the earnings, you must divide it by the number of shares out there in the market to actually make it earnings per share. And with that, we actually get this thing called the price to earnings ratio. Now, what does the price to earning ratio mean, and what is good price to earning ratio, what is bad price to earnings ratio? Now I'm going to break it down for you guys. It's really simple. So as a general rule of thumb, anything of a PE ratio under 15 is considered good and it's undervalued. Right? This is just a general rule of thumb. Don't ask me why is it 15, why can't it be 20, why can't it be 30, right? So the easiest way to explain this general rule of thumb is simply like this. It actually tells you the 15 years tells you how many years the P ratio, for example, is 15, tells you that it will take 15 years for you to break even on your investment. Okay, so you want to actually break even as soon as possible. You do not want to break even as as late in the game as possible, right? So I'm going to share with you guys later more on what are some stocks that takes a very long price to earnings ratio. A huge P ratio takes a very long number of years for you to break even, and some stocks that are actually easier for you to break even because it's low PE ratio, and that's why a lot of investors are into these specific stocks. Okay, so let's go for a quick example. So price to earnings ratio, imagine, right, you're a house owner of this house, like you're actually going to rent it out, and before you rent it out, you actually purchase this house at $450,000. Okay, now you rent out for around $3,000 per month for this house you just bought at $45,000. So here's how the breakdown goes. You bought the house at $450,000. You rent it out, and the earnings per year is $36,000 because $3,000 times by 12 months, you get total of $36,000 a year. Now, with that said, the price to earnings ratio, remember, you take the price, divide by your earning. So your price is $450,000, divide by the earning is $36,000. You actually get 12.5. Now, in this situation, it is below 15. Right, when it's below 15, it tells you it's actually kind of like undervalued. And what does this 12.5 means to us as investors? It basically tells us that it takes around 12.5 years for your initial investment in this purchasing of house to break even for you. So at the 13 year or the 12.6 year, right, which is like maybe the 12th year and July, because July is the 7th month, right, you actually start making money already. Okay, this is break even. This is 100% break even. We're not talking about profiting, we're just talking about break even. We're not talking about buy now, sell later. We're just talking about purely break even. Okay. Now, in the next example, right, let's just say you only managed to rent out the house at around $1,500, which is kind of like average, right? $1,500. Then again, we let's work out the whole calculation. You bought the house at $450,000. Your earnings a year is $18,000 because 1.5k times 12 months is $18,000. Now, with that said, let's work at the price to earnings ratio. That is 25. Now, this means it takes you 25 years to break even on an initial investment of $450,000 because you are only renting out at $1,500 per month. All right. So I hope this example helps you to clarify on what is price to earning ratio. I hope it actually really helps you to understand. So if you guys have any feedback, please comment in the comment section below. Let me know and how I can improve to share with you guys this knowledge to you guys. Okay, so let's move over to how you can analyze all of this in just 1 second. So who is your best friend in terms of stock analysis or anything else, right? Just take a quick guess, right? There's no prize for that, okay? But anyway, okay, so let me just tell you guys the answer because I'm literally talking to a camera right now and there's nobody's replying me, right? So everyone's best friend is known as Google. All you need to do is just simply type in the stock you're interested in and what is the PE ratio. So you just need, for example, you're looking to know about Singtel's PE ratio, price to earnings ratio. Just simply go over to your Google platform, type Singtel, and just type stock. Okay, Singtel stock. So let me just quickly hop over to my Singtel stock, my Google over here. So you can see I just simply type Singtel stock. All right, then Google will come out with this Google Finance, their stuff, and they'll come out this thing here. Like I tell you what's today's share price, last 5 days, last month, 6 months, all this kind of thing. It's really like straightforward. Don't need to do anything. But if you notice over here, you can see there's a P ratio here. They actually already calculate for you what is the P ratio. So down here it puts the P ratio is 37.18, right? 37.18 over here. Now what does this mean? This means it takes you 37 years for you to break even on your initial investment of whatever amount you go invest in, because this is their current earnings power compared relative to their price. Okay, so this is 37 years. Let's take a look at, for example, maybe you want to invest in company like DBS, right? So sorry about this, DBS Singapore stock price. Okay, maybe DBS here, I need to type in the ticker symbol. Never mind, just the OCBC stock price. Alright, so for OCBC, you can see down here the PE ratio is 10.33. Anything below 15 is generally considered undervalued and good. Alright, so we want to actually invest in companies that's below 15. So for example, we look at OCBC, a stock that we all are aware of. It has a P ratio of 10.33. So this is good and we can actually look towards investing it. And on top of it, there's a huge bonus whereby the dividend yield is 4.43%. Okay, 4.43%. So it's actually higher than CPF lah. But then again, we have not even looked at any financials or the fundamentals of the company. So do not just buy blindly. Alright, so you have to still study what is this business about, right? Knowing the PE ratio helps you to filter stocks easier for you to actually see which is overvalued, which is undervalued. So you can actually do your analysis. You can actually filter out them faster. You can throw away all the overvalued one and just focus on the undervalued one. Then focus on the very, very good business fundamentals, followed by the very, very good business financials and balance sheet, all this kind of stuff. All right, so this is what you want to be looking at. You really help you save a lot of time. Just 1 second. So imagine if you're looking for like a US company, right? US company stocks. You can also, like, for example, let's look at Facebook stock price. All right, Facebook has a PE ratio of 33.15. Simply, you just need to type in a ticker symbol or Apple, AAPL. Apple stock price has a PE ratio of 25.4. So now, looking at this PE ratio thing, you also want to compare between PE ratio, right? So for example, you want to be comparing between two companies and you want to know which company is better to invest in, right? So let's just say, let's go apples to apples, right? Let's go let's go Singtel first. Singtel stock price P ratio of 37.07. See, you see, it actually calculates for you even if share price come down already. So it's really very convenient for you guys. And then you want to compare it with, for example, Starhub stock price. So you see Starhub stock price is 15.26. So generally you want to be, since they are both in the same telecommunications sector, you want to be investing in the one that has a smaller PE ratio because you actually break even faster. But then again, I must state it clear here again that we have not looked at the business fundamentals, we have not looked at the business financials, all right? We're just simply comparing apples to apples in the same industry, same sector. What is the PE ratio and how should you make a decision based on this PE ratio? Which one to throw out the window, which one to dive in further to investigate more, okay? So I hope you guys actually learn a lot from today's series, the Alpha Learn series. Do once again remember to actually come back to this. Let me just scroll back. This QR code. Remember to scan the QR code, and you'll receive all the unlimited stuff for free in the forever. You know, it's literally forever, and it's free for you guys. And we're gonna update it as and when as we can, as almost every other day if possible. All right. So hope you guys learned something, and we'll see you in the next session. Bye bye.